This episode is brought to you by Elevate OS, the only all-in-one community operating system. Elevate OS transforms property management, combining resident engagement, reservations, rent payments, maintenance, and concierge services into a single super app. It also uniquely integrates access control, intercoms, package lockers, and thermostats, eliminating app fatigue and redefining modern apartment living. Visit elevateos.com/MMN for a free demo and see how they can help you level up your operations. Welcome to another episode of the Multifamily Collective. This is the time of the week where you grab your favorite beverage. For me, this week, it is the MMN blend. That is a mouthful. The MMN blend. And you grab your favorite beverage. I'm going to grab my MMN blend. And we're going to pull up a seat and we're going to enjoy this conversation with Kurt Houtkooper, who is the CEO of Hamilton Zanze, a San Francisco-based multifamily investment firm. Since its founding in 2001, Hamilton Zanze has sponsored the acquisition of over $7.5 billion with a B in multifamily assets, primarily in the western, southwestern, and eastern United States. The company's portfolio currently comprises approximately 125 properties across just under 30 markets. Kurt graduated from the University of California, Berkeley, and now lives in Marin with his wife and 3 daughters. This conversation with Kurt was fantastic. We talked a lot about the San Francisco real estate market, multifamily market specifically. We talked a lot about Hamilton Zanze spread across the country post-COVID, certainly into 2024, and then what he perceives to be a good unlock in the market for 25, 26, 27 in the out years. We talked about everything from the market to, yes, AI seems to be the topic du jour these days. So we did include some AI and his thoughts on AI, did some outsourcing, offshoring, and things of that nature. But this was a fascinating conversation with Kirk. And I'd really encourage you to again, grab your favorite beverage, get out your favorite writing utensil and your favorite thing to record your thoughts on, and get ready. Enjoy this conversation. Kurt, welcome to the show.
Happy to be here. Thanks, Mike.
Yeah, definitely. I thought, Kurt, that we could start out by just having you talk a little bit about your firm and the portfolio makeup.
Yeah, sure. So Hamilton Zanze and Company, we're based in San Francisco. Apartment operator. Our portfolio, we're in 17 different states, 28 different submarkets. So for us, a submarket, if you look at Colorado, go up and down the Front Range, we're in Fort Collins, we're in Denver, we're in Colorado Springs, and 22,000 apartment units. If you think about the profile of the apartment communities, it's garden style, suburban apartments. We have some urban assets as well, but for the most part, we're suburban style apartment communities. In terms of the capital stack, we're generally working with Fannie Mae or Freddie Mac on the debt side. And then our equity is put together on an asset by asset basis. We are definitely specialists in 1031 and exchange capital. So we organize a lot of our capital as Delaware statutory trusts or tenancy in common structures. We also have a portion of our platform that is based on institutional partners. So we'll do joint ventures with household JV partners as well. In terms of the structure of the company of Hamilton Zanze, we are vertically integrated. So at Hamilton Zanze, as the operating company based here in San Francisco, we're going to have, our asset management functions, investor relation functions, transactions, construction management, accounting, executive branch. And then we also have Mission Rock Residential, which is our affiliated property management company. Mission Rock is based in Colorado. Patricia Hutchinson's the CEO. We have combined in our companies close to 1,000 employees. And that's kind of the long and short commercial on Hamilton Zanze.
And my imagination tells me, I know you mentioned Colorado, but assets from California all across the country or particular?
Yeah, it's so we're based in San Francisco. We do have assets in California. I'd say as an evolution of the company, when Mark Hamilton, Tony Zanze started the company in 2001, they contributed assets to set up the first portfolio. And those assets were just California-based assets. I joined the company in 2002. We started selling out of California in 2004. We really just, there was a number of reasons, but it started with we didn't love the regulatory environment
Sure.
for housing in California. Plus, we thought that we could find higher returns, more distributable cash flow that we could send to our investors outside of California. And so we really started growing into other states at that time. Having said that, we started buying back into California again in 2021 and have bought a significant amount of housing real estate in California over the last couple of years. Regulatory environment hasn't changed, but we think returns have made it worthwhile for us to come back in. But the majority of our portfolio is outside of California, and you can think of it as the Smile. So it starts in the state of Washington and it wraps around to the Northeast. We do have a generous sized portfolio in the Southeast, Mid Atlantic, and then we really like the Western U.S. So Pacific Northwest, Mountain region, and into Nevada, Arizona, Texas.
Got it. So if you go back to 2001, 2002, and you were thinking about your investment philosophy on a go forward and identifying that you wanted to invest in the Smile, get outside of California a little bit, kind of talk to me about what were those strategy meetings like when you were trying to identify those out markets and maybe some of the fundamental principles that you were thinking about as it related to the investments that you wanted to make?
Yeah, so really it starts with our own capital. When we decide we're going to deploy capital, put money into something, it starts with the Hamilton Zanze capital. What do we want to do? What are we looking for returns wise? And then we'll invite our investors to invest alongside us. We felt that, especially when you have exchange capital, which again, we're specialists in the exchange side, and we're looking at our own money as being included in this exchange capital. Our thesis and investment philosophy is around capital preservation, distributable cash on cash return, what the after tax returns are, and then growth. And growth comes in last for us. And so we really wanted to get outside of California because we felt that we could offer higher cash on cash return to ourselves and to our investors. And so we initially moved out of California. We went into the state of Washington and we started to grow into other Western states right away into Nevada and then Arizona. We've always been big believers in investing in Utah. Colorado is one of our biggest portfolios. At one point, we were one of the largest private investors on the Front Range, and we still have a significant size portfolio in Colorado. Again, we believe in the capital preservation and distributable cash flow that you can get outside of California.
That makes absolute sense to me. So I'm curious if we sort of fast forward to today and we're thinking about post-COVID and I'm going to call it a tricky environment, for lack of a better way to put it, that we've been operating in. How has the philosophy been impacted, and or how have you navigated, let's say 23, 24, and then we'll talk about 25, 26 in just a second, but how have you navigated this, what is really a tricky and tough market as of late?
Yeah. So, maybe I'll approach that a couple different ways. The first is, the during COVID, what were the renter trends, right?
Mm-hmm.
And then post COVID, we can talk about some of the trends maybe in capital markets. One of the reasons why we're interested in moving back into California is you had this real urban to suburban trend that occurred, but for renters during COVID. And now we're investing in San Francisco. We think that is a target market for acquisitions because we're seeing the reverse. We're starting to see that suburban to urban trend. We're starting to see young people moving back into San Francisco. And so we want to capture that potential upside now. We're seeing distress in the market in San Francisco, and I'm sure we can do a deeper dive into specifically the San Francisco market. But as a COVID trend, we're seeing the reverse happen now. We're seeing suburban to urban movement. And so we're positioning ourselves to take advantage of that. Obviously, in a portfolio prior to investing in San Francisco as a garden style suburban multifamily operator, we benefited from the urban to suburban flight that occurred. During COVID, it was a really interesting time of empathy, right? where
Yeah.
everybody was looking out for everybody else. The resident looked to the landlord, and the landlord was helping the resident. The landlord looked to the lender, and the lender was helping the landlord. I mean, there was real kind of help throughout the system during that time. So that was kind of an interesting piece of the pandemic, to see how everybody supported each other. Today is clearly just a very different time, and there's a number of trends that are starting to pop up that were maybe different. But also, one of the things that we're seeing right now is this is a period of some dislocation that's in the capital markets.
Sure.
And so as an operator who's looking for returns for our investors, we're looking for opportunities that are within, dislocation. Most of that dislocation is in the capital markets.
Do you feel, going back to San Francisco specifically, or this urban to suburban, do you feel like one of those drivers is return to office and people are moving back to the cities because they have to go back to the office? That's a curious if that's one of the drivers you're looking at.
Clearly, that's a driver. I mean, now, you have Salesforce saying, come back to the office in San Francisco. You have Amazon saying, come back to the office in Seattle. And so you're starting to see, significant uptick in leasing and occupancy levels in urban markets that, if there was a hybrid work schedule or even work from home work schedule, occupancy levels in office buildings were really impacted and people just weren't going downtown. So now, as we're seeing this, a lot of venture capitalists telling their startup companies that they need to be in the office, and they're requiring their employees to be in the office, we're now seeing an uptick in occupancy levels of office buildings, and corresponding, you're seeing an uptick in occupancy levels of apartment buildings.
I'm curious, as it relates to that, your own company, how does your firm think about working in the office? Is that something that, I mean, everybody shifted obviously during COVID, but what is your driving principle?
We treat ourselves as a private equity company, so we feel that we need to be nimble, we need to be aggressive. We have a responsibility to our investors. We think the best place to be our best selves is to be in the office, where we can collaborate, we can work together, we can grow the next generation of leaders. So we are currently on a 4-day in the office, Monday through Thursday. We invite people to be in Friday, but they can also work from home. And we talk a lot about when we're getting back to 5 days. One of the significant reasons why we think people need to be in the office is just to support the other small businesses that are in our community.
Yeah.
And we feel that there's a bit of a civic pride that we want to be part of the recovery of San Francisco.
I love that. And it kind of goes back to the word you used, empathy, right? And during COVID, there was certainly an exercise of empathy, but now there is an exercise of empathy that's a little bit different target or focus. And I really like the way you're thinking about that.
Yeah, we cohabitate together in San Francisco. Let's support each other.
Yeah. And I don't know about you, but I've always felt like there is a different energy when you are in person versus you and I even speaking right now, right? When I can feel your body language, not to be weird, but when I can feel your body language and the way you react, right? I sort of key off of that, and it's just different, and I think it's more productive.
Yeah, I mean, we ask the question when we're interviewing people, are you okay with 5 days? We ask our vendors that we're working with, attorneys, hey, are you guys in 5 days a week? And if you're not, why not? We ask our insurance company vendors, we ask all the vendors who are doing work with us, what are you doing for back to, being back in the office? And so we think it's really important for the future of Hamilton Zanze for people to be in the office and to be able to work together and feed off of each other's body language, and just having that personal touch where we're together. Look, we think we're a very innovative company in a lot of different ways. And, when people think innovation, they think PropTech, but it doesn't have to be PropTech. You can innovate in a lot of different ways. And, as being a leader in the 1031 space, the exchange space, we are structuring our deals a little bit different than other people. And we want to be at the forefront of how we put that together. And it's so much easier. And we also just think we're so much more productive when we're innovating together. So, yeah, it's important.
Yeah, I definitely agree with that. There's something about being able to walk down to somebody's office that's 25 steps away, right, and poke your head in, or talk at the coffee machine or the water cooler or whatever it is. It's a very different environment.
Yeah, my door's open. My door's open, and it happens all the time. And my phone's on, and I don't have the people just walking into my phone, right? Like they aren't just picking up the phone and having a
Right.
conversation, whereas they do when they just walk.
Yeah, that's right. It's yeah, I I love that. So let's key. I love the word innovation. I actually, to your point, I used to think about that as prop tech. Then I looked it up in the dictionary one day and I saw the word change next to the word innovation. And you talked about uniqueness in the way of structuring deals. Are there other ways that you're thinking, even if you're thinking about the operations side of the business, other ways that you're innovating as an organization as we move forward into 25, 26 and the out years?
Yeah, I mean, clearly, I think you're asking about prop tech and what we're doing there. So, as a we have a lot of data at
Yeah,
Hamilton
that's right.
Zanze. We have our own property management company. So, we currently own 22,000 apartment units, but we've owned over 50,000. We're also investing in some private credit. In the Freddie Mac K series, there's a lot of data involved there. So we have access to a lot of data. We have a lot of our own data as well, and so we think a lot about what we can do with that data. Everybody's been focused on AI. I'm still really focused on the data collection side, how we are going to use that data. Like what are we really doing with all the data that we have? AI, we're hoping that AI puts us in a position to tell us what we can actually do with that data.
Sure.
It helps us get to that point of saying, yeah, this data is telling you this, and this is what you do with that data, right?
Hmm.
But look, we have a pretty sophisticated tech stack. We think about our tech stack as kind of being multi-pronged. We have the tech stack that maybe you would call it, and this has a lot to do with your background, Mike, is it's really more on the property management side or asset management side. So what you do with data at the real estate. And then the other side of our tech stack is the investor relations tech stack. And those are two very different things. The backbone of it all for us is Yardi. One of the trends that we're doing right now with our tech stack is we're trying to consolidate. Right? So we have all these different apps, modules, all these different things that are coming off of our backbone that you pay fees on, right? Recurring revenues that are
Right.
going to those software companies. And so we're trying to actually, as our tech stack over the last couple of years just kept being bigger and bigger and bigger,
Yeah.
and we were constantly onboarding. And now what we're trying to do is we're trying to take some of those off, but some of the companies that we're working with actually offer more on their existing platform where they can pick up some of the things that we're taking off. So we're seeing a consolidation in technology in our tech stack right now, both as a way of eliminating costs, but also as the ones that we're keeping are becoming more dynamic and can do more things for us. In terms of AI and how we are innovating, we're very invested in startup prop tech companies. We've either invested in them directly ourselves or through venture capital companies, and so we're seeing all the prop tech companies that are out there that fall into either property management or in the investor relations side of our stack. We're not necessarily first adapters when it comes to that. We like to see how they're going and where they're disrupting or where they're offering value. I would say that we are using AI. We're using AI on the leasing side. We're using AI on the maintenance side. And we are figuring out ways that we think that we can do more on the operating side too, from being an apartment operator. What are we doing in research with AI that will make us better on the acquisition side? And how are we using that data that's coming to us? Again, I'd say one of the big things for us is we're collecting data. We have it. We got to get the dashboards exactly where they need to be. But we're so much more advanced than we were last year or even 2 years ago. And we're going the right direction.
It's the pace of acceleration or the accelerating pace of AI, especially, but some of the other sort of prop tech companies is just it's mind blowing. You wake up. I have 5 newsletters I read every single morning on the topic of AI, and then some that are more specific to multifamily, and it's just no one can keep up. It's happening so fast, or it's changing so fast. So on that note, I'm curious from an organizational standpoint, because this question comes up over and over and over as I do these interviews and in other discussions that I have, is how do you as an organization, obviously you're investing in PropTech, but let's think about operations for a second or asset management for a second. What is your process? How do you sit down and think about how you vet technology or how you introduce new technology into the stack or how you exit something from the stack? Do you have a formal process in your organization that you use to do that?
Well, it makes it easy when we're investing in VC companies that are very focused on, any kind of revenue generating for apartment buildings, right?
Mm-hmm.
Anything that's, that process becomes really simple, and it almost becomes, our vetting, right? That's kind of the vetting area, is being involved, invest in the VC companies, but also be really involved
Mm-hmm.
in the technology that they're looking at, right?
Like the feedback loop that.
Yeah, exactly. So that is a great way for us to see all the different options of startup companies that are coming into prop tech, right? And if we want to be a seed investor in them or not. So get in early, understand the different areas, and do it through the VC companies has obviously worked out really well for us. When it's an independent that's not coming through us, then it's going to run through either, look, is it going to be on the property management side? Right? Or is it going to be on the operator or investor relations side? So then we decide, where that potential technology application is going to go, and then there would be a bit of a vetting process, and it would probably be a pretty long process if we were going to decide to put it into our tech stack somewhere, and there would be a testing involved on one property and then a couple of properties, right? I mean,
Yeah.
we're pretty slow when we don't just put all 125 properties on one tech immediately.
That makes sense. I'm thinking about an aspect of your business, the asset management piece, or even the underwriting piece. Are you, as it relates to those couple of things, are you offshoring and or outsourcing some of those responsibilities?
Yes. Yeah, we are. So we're clearly doing it in transactions. So in our underwriting, we have our pro forma, and we'll take all the data and drop it into our pro forma on transactions. So that helps us with the first step. We still have our transaction team that is going to review the pro formas that are completed offline, where the data is basically put into our template,
Sure.
offshore, right? And it'll come back. I mean, it's just done overnight, right? We're going to tell the system, all right, feed this in, and then when we come back to work in the morning, it's in there. We review the data, we make sure it's accurate. It helps us decide if it's something we want to buy. And look, I mean, we have the ability to do so many more transactions because of data entry being done offshore, and I'll tell you, it's accurate. The templates that come back as they're filled in are accurate. So, and it's really helped us as we do more acquisitions of portfolios when we're not just doing one-off acquisition. We can do it so much faster.
Yeah, I have to imagine, because that is such a heavy lift. If you're buying multiple properties at a time, you offshore that. And it's interesting too in terms of the time zone, right? They're working while you're asleep, and then right, and just the opposite.
It's awesome. I mean, it's clearly it's a great way to go. It did take us a while to onboard and vet and make sure that we were comfortable with the people that we were working with, but it's worked out. Asset management is now also um, offshoring some of their. It's again more data entry than anything else. So yeah, the offshore data entry has really worked for us.
So I'm just curious, keeping the theme going, but maybe backing way up and thinking globally and maybe broadly across the industry. Do you think, whether it be personally or on behalf of your firm, do you think that AI or this type of technology where you can offshore rather, will impact employment in the way of reducing headcount, and or do you think you're going to be able to employ that technology in a way that you make, hey, Mike's now a more productive employee because he has the assistance of AI? I'm just curious how you think about that.
Yeah, I mean, long-term trend probably impacts employment. I mean, I'd say right now for our acquisition group, as we're offshoring data entry, we just have the ability to do more.
Yeah,
So it's really just productivity. I mean, we're gonna have the ability to find and look at more deals. And as you look
that's
at
right.
more deals, the better ones just come to the top, right? And so it'll allow us, speed of execution, seeing more opportunities, finding the ones we like more, reasons why. So there'll be that. In terms of ultimately, will there be an AI program that can do exactly what offshore is doing? Of course, it's probably, right around the corner. I
Yeah.
mean, it's here. So, I mean, is that going to impact Hamilton Zanze and the employees that work for Hamilton Zanze? No, we're still going to have the same number of employees. Are we going to have a consulting contract with offshore? No, it's going to eliminate that. And we'll have an AI contract.
Yeah. Yeah. I think that's right. So let's shift that to your sort of looking at 2025. You're underwriting as many deals as you possibly can. The market seems to be a little bit stuck right now. It doesn't mean that transactions aren't happening, but they certainly aren't happening at the volume they were, let's say, 3 years ago, plus minus. What is your take on 25, and is it going to break loose, or are we going to continue to stay stagnant?
It's going to break loose. I mean, clearly you're already seeing it in M&A activity, first quarter of 2025. So our belief is, I mean, number one, our philosophy is don't try to time the markets, invest through the cycles. We've always done that, and it's always been a good thing for us. In terms of the different types of capital that we have, exchange capital, again, you don't have to time the markets because you're selling in an existing market at the same time that you're buying into an existing market. And so, that it's not as important to be as smart as you can be in terms of deployment of capital. And so we're investing our exchange money at all times. We're never trying to be a market timer when it comes to that type of capital. Look, institutional capital over the last 2 years has just been on the sidelines. The
That's
same as
right.
banks have been on the sidelines over the last 2+ years, not deploying capital. Institutional equity has been on the sidelines.
Hmm.
So transaction volume as a result has been low. We are believers right now is a great time to be a buyer. So we are anticipating a big year on the acquisition front. We did close to $1 billion in 2024 of transaction volume on the buy side. Probably a bigger number than most companies, but again, we weren't trying to be market timers. And then what we anticipate in 2025 was closer to $1.5 billion. I wouldn't be surprised if we're over that on the buy side.
Got it. Yeah,
I mean, there's a number of reasons. I think all of our different ways that we invest, exchange capital with institutional partners. And just private capital investment in general, separate account business, all of those segments are going to want to deploy capital.
that's right.
Look, we'll go into all the different reasons, but right now we look at 2026 and 2027 as being real rent growth periods. And so in anticipation of that, we want to put our capital into the market today, as we're seeing a real, stabilization of rent rolls right now. So invest today with anticipation of rent growth in 2026 and 2027.
I definitely think supply demand, right? Atlanta had a lot of units put into the marketplace, but I think we're slowly but surely absorbing most of that inventory. So I think to your point about 6 and 7, you're going to see migration and household formation pick up, and then because construction is so far behind or it lags, right? You're going to have this period of time where rent growth will probably, it's not going to be like it was 3 or 4 years ago when you get in 20% a year or something like that. I think we saw markets like that. Are there markets that are on your radar that stand superior to other markets?
So look, in terms of acquisition, yes, we have a tiering system that really we target ultimately what we think is going to be high rent growth. I mean, I think everybody has a tiering system, and everybody's tiering system gets to the same place, which is which market's going to have the highest rent growth. And then you have to decide for your capital, which markets are the best for you. So yeah, I mean, we think that there are certain markets that we're going to target as buying opportunities. In terms of existing operations, yeah, I mean, clearly there are just, different markets have performed better than other markets. If you dive into our portfolio, again, mainly being the Smile, we have some Midwest mountain regions, markets that were oversupplied are struggling the most. And then markets where you have a hard time evicting people. Usually it's legislative or sheriffs are just too backed up where you have a hard time evicting people. And so those are markets that have also struggled. Our portfolio at the end of 2024, we were at about 93.2 occupancy level. A little lower than we want to be, especially in the winter. And, January and February are not good leasing months for the most part. So we like to trend in the 94.5 to 95 at the end of December, lower than we want it to be as a portfolio. I would say as we did our budgets in the fourth quarter of 2024 and we looked forward to 2025, we felt really good about the strength of the budget. When we did our budgets in 23 for 24, we felt it was loose. Like we were concerned about the direction of top line.
Yeah.
Across the portfolio. And again, mainly because of supply issues that we were dealing with. And when you really think about supply, most supply happened in major urban markets, but it was also impacted in transit-oriented developments in the suburbs. And that's where we were generally impacted, was in some of these TOD areas. So supply had a big impact. There was a lot of deliveries that happened in 23, 24, and now in the beginning of 25 that, just there was an imbalance. It was in favor of the renter instead of the landlord. So what we're seeing now is as we do these budgets, as we did our budgets, the end of 24 for 25, is that rent rolls are firming up. We believe that we're going to get to a point of equilibrium in 2025 where, it's no longer in favor of the renter and it's not really in favor of the landlord either. There's just this balance between the amount of supply and the amount of demand that you have, because we're still seeing absorption.
Yeah.
Right? It's just slow. Our year-over-year rent growth from 23 to 24, December of 24, was 1.8% on the rent rolls. And that's same store, obviously. So we still had 1.8% growth, but it tells you, if you look at inflation, right? I mean, housing seemed to be right in line with, that 2% target. Our NOI growth was about 1%. So it was a period over the last couple of years of oversupply. We're anticipating 25 to be equilibrium, and then 26 and 27 where you start seeing some rent growth. That's clearly because there are just no shovels in the ground right now. Right? You are not starting to build apartment buildings in today's market. So then you're going to have more demand.
Yeah, that's right. And I think to the extent, it takes a couple of years to get a building out of the ground and ready for leasing, right? So anything that, even if it started today, it's 2 to 3 years removed from now before you actually start the lease up and occupying those buildings.
That's right. 24 to 36 months is kind of what delivery timeframe is going to be. And it's been really hard over the last 2 years for anyone to get a bank loan. A lot of banks provide the financing for apartment construction. Look, banks have been shut down, right? Over the last 2 years, they were doing 10% of loan originations that they had done compared to 22 and 2021 and 2020.
That's right.
That's a significant reduction. And they weren't doing apartment loans because, look, new deliveries were competing with other new deliveries, right? In markets like Austin, Colorado Springs, right? Like all these oversupplied markets. And so concessions really started to build up for landlords, right? They weren't achieving the rents that they needed to achieve. Land values dropped significantly because there was no buyer for land, right? And so you just have this situation where developers were struggling with their existing product. we're not ready to put shovels in the ground on new stuff because rents didn't justify it and because they couldn't find the capital to do it.
That's right.
And so you don't have any shovels in the ground. That's the result.
Yeah, definitely. I am curious. This is scratching my own itch on the cost side of your underwriting. Have you seen a dramatic shift in? Obviously, insurance has been a big deal across the country, primarily in Florida, but in other markets, California probably as well. Anything on the cost side that's giving you a headache or heartburn as you look forward?
We're expecting expenses to decrease.
Yeah,
So
finally.
it's finally right. So what are look over the last 6 years prior to 2025, our insurance premium went up 186%. Well,
Just
it's only 5% of our expense load. So insurance is only 5%. So, we
right.
talk a lot about it, but it's not going to blow up anybody's pro formas. I'm buying something, your insurance is up significantly. But the reality is this year, we've already paid our 2025 premium because you pay it in advance, and we're down 17%. So
Nice.
insurance is decreasing, right? There's more insurers that are coming to the market. We don't have a lot of fire risk in our, so, like our portfolio may be a little different than what you're hearing in terms of if there are providers in California, especially providers for single family homes. Our multifamily portfolio is down 17%. There are more insurance carriers that bid for our program this year. Reinsurers are still, for the most part, sitting on the sideline. I don't think that there's a lot more reinsurance money that's coming to the market, but there are more insurers that are bidding programs and bringing the cost down. And insurers, made some money in 2023 and 2024.
Yeah, that's fair to
So,
say.
yeah, it's good to see. So in terms of non-controllable expenses, our non-controllable is coming down. Insurance is down 17%. We're applying to reassess on property taxes because, look, property valuations went down 15, 20% across the country for multifamily. So we're applying for reassessment of property taxes. We're expecting that to come down. And then we also went through a whole bidding process for payroll benefits. Payroll benefits came down pretty substantially too. So when you look at the portfolio, a lot of the line items are staying flat, and then other line items are going down.
Yeah.
So we love that. When you enter into 2026, where you're starting to see rents going up and expenses going down, abundance of capital that's coming to the marketplace that wants to invest in multifamily, we think multifamily is a great place to be right now, and it's also why we're looking to actively deploy capital today.
That sounds like a fantastic end cap to our conversation. But I do want to. Is there anything that I have not asked you that you think would be important for our audience to hear today?
Yeah, I think, look, the question I get a lot is distress. Where are you seeing the opportunity to deploy money into distress? The reality is we're not seeing a lot of distress in the multifamily space. We're buyers of Class B assets, A minus assets. So, we're value add or core plus types of buyers. But we're not really buying Class C properties. And, there is some distress in the Class C space. We're not playing in that. And then there's distress in capital stack. So not in the real estate. Across the country, you're 93, 94% occupied,
That's fair.
right? And absorption is there. And so, assuming that we don't have a recession that hits anytime soon, right? Occupancy levels are good and getting better. And so distress is in the capital stack. Banks were out of the market for the last couple of years. Banks are now back. The big banks are now back in the marketplace. So that's strength in the financial sector, right? You had the decrease in rates that happened at the end of 2024, signaling that you have an easing monetary policy. When you have an easing monetary policy for big capital, that generally means risk on. And so when you have risk on, you're going to start seeing M&A activity. You're going to start seeing investment sales activity. You're going to see more flow of capital in general. So as we go into 2025, you should expect to see more of that, which will solve capital stack issues that people have. What we're seeing as the opportunity, and this is very specific, but we are seeing rent control markets like New York City, San Francisco,
Mm.
LA as being the best distress opportunity in the country. So that's where you are actually seeing borrowers that are declaring bankrupt, right? Or foreclosures that are occurring by lenders. And it can't be an extend and pretend situation because the value has decreased so significantly because you had this trend of occupancy levels going down because of the urban to suburban, right?
Yeah. Yeah.
At the same time that groups took floating rate debt on their properties in 2019, 2020, and that floating rate debt has gone up so that
Right.
their debt service is significantly higher. And so they can't pay their debt service, plus occupancy levels are down. And so you've got distress. And so we think it's the best trade in the country right now to buy into San Francisco. And we also think that the city has changed significantly. And you're starting to see this reemergence of San Francisco back to the prominence that it used to have, right?
Yeah.
And
Yeah.
it's happening in a lot of ways. Obviously downtown's important, but we're at an office vacancy rate of 40% and it's going down, right? There
Yeah.
are 82 AI companies that signed leases in 2024.
82.
82. There's significantly more behind that's taking office space. You have
Yeah.
office tenants that are telling their employees they have to come back to the office. So you've got the dynamic of downtown recurring. The legislative environment is now known with the election, the local elections that we had
Yeah.
in 2024. Now there's visibility as to what rent control really looks like. So you've removed risk. So that means that capital is now willing to invest back into San Francisco, knowing what that looks like. The social ills of San Francisco have gone away. We have a new mayor.
Mm-hmm.
We've changed out the political structure that's here, allowing for us to clean up San Francisco homeless issues. So the social ills are going away. And now you see all these young people moving back into the city. So we think that that's a great trade. We're excited about that. We're just not seeing that dislocation or disruption in other markets. It's very specific to San Francisco, LA, New York City.
Got it. Understood. Yeah. San Francisco is a great city. I was there in 2001, and it was incredibly vibrant and just a wonderful place to be. Traffic, not so much, but the city itself was amazing. Kurt, it's been an absolute pleasure to talk to you. I want to end just by allowing you the opportunity to tell people where they might find out more about your firm, or if they wanted to reach out to you directly, how would they do that?
Yeah, HamiltonZanze.com. That's the best place. So you can find me there. Definitely find out more information about who we are. And love to hear from people.
Excellent. Well, thank you for your time today. I appreciate you investing a little bit of it with us.
Thanks, Mike. A lot of fun.
Thank you.